Welcome back to the Deep Dive. Today we're looking at CreditAccess Grameen's latest investor materials, Q2 and H1 for FY26. And there's a real story here. It feels like, financial urgency meeting structural reform. You see this company taking these huge decisive steps to clean up old bad debts.
Right. Very irritating.
Stabilizing the core portfolio,
Yeah.
only to then, bang, walk straight into a pretty significant forward-looking hike in expected credit costs. Feels like regulatory modeling is hitting them.
Exactly.
So our mission today is pretty clear. Cut through the finance speak, get a clear view of this dramatic tension. What drove performance up to September 30th, 2025? And maybe more importantly, what does this kind of mandated risk reset mean for their profit targets over the next couple of years?
Well, the core conflict, as I see it, is speed versus regulation. Management went for really aggressive balance sheet normalization, took the pain, big write-offs to clear the deck.
Get it done quickly.
Precisely. And that gives us immediate, clear visibility on their current asset quality. But this quick cleanup, it's needed because they're planning for this critical strategic pivot. They want higher quality customers, and they need to prepare for that regulatory expense hike that's coming.
Okay. And the raw lending numbers, they still look strong despite all this internal surgery, right?
Oh, yeah, the engine's running. Disbursements were pretty robust. INR 5,322 crores for the quarter. That's up, nearly 33% year over year.
Wow.
And the gross loan portfolio, the GLP, it grew to INR 25,904. So yeah, they're still lending successfully, even while, fixing the existing book.
Okay, let's unpack this aggressive surgery then.
Okay.
Because the scale of the write-offs, it's kind of breathtaking.
It really is.
H1 FY26, they wrote off INR 1,375 crores. And that includes INR 683 crores in Q2 alone. Focused mainly on those really old accounts, right? 180 plus days past due.
Yep, the deep delinquencies.
So, if they're taking that big hit now, does that mean we should maybe look past the quarterly profit number, which was obviously down, and focus more on the forward-looking health signals?
That's exactly the right way to look at it. The immediate intended result of that huge write-off exercise is, balance sheet normalization. Purge the worst assets, and you immediately improve the headline risk metrics.
Like PAR 0 plus OC.
Exactly. Portfolio at risk, PAO 0 plus OC, any account overdue. It dropped from 5.9% in Q1 down to 4.7% in Q2. That's a significant improvement.
Yeah, that definitely signals stabilization.
Absolutely. And the core NPA metrics are also normalizing. PAR 90 plus AUTE, the serious delinquency, was at 2.50%. And the gross NPA ratio, that's 60 plus DPD for their group loans, stood at 3.65%.
Okay.
But maybe more importantly, the cost they're incurring from new loans going bad, that seems to be slowing down. Credit cost actually declined from Q1 to Q2.
Okay.
So that tells you the stress was really coming from that legacy book they just wrote off, not so much the fresh loans they're adding now.
Right. But the sources did flag a complication. Even with the cleanup, the monthly PAR 15 plus accretion rate, the rate new loans were just starting to go overdue, was described as range-bound. And the reason was temporary impact from heavy rains, floods across their operating areas. How big a deal are those kinds of localized external factors in microfinance?
Oh, they're critical. Absolutely critical. You have to remember, this isn't corporate lending. We're talking about customers whose entire income might depend literally on the weather playing ball.
Right. Agriculture, local trade.
Exactly. Flooding can just wipe out crops, stop local commerce dead in its tracks. That immediately hits repayment capacity. It's a huge risk, and it's basically unhedgeable in rural microfinance.
So it's always going to be a factor.
It will. But the key takeaway here is that management seems to be containing that damage. We saw PAR reduction continue across all geographies. Look at Karnataka, their biggest state, about 30% of the GLP.
Yeah.
Their PAR 90 plus dropped sharply. It was 5.1% in June, down to 3.9% by September.
Okay, that's a good sign.
It really is. It validates the cleanup strategy in their core market and then gives management the confidence they need to tackle the next big structural challenge.
Okay, so if the localized issues, like the floods, seem contained for now, management can shift focus to the bigger picture, right? Changing who they lend to, making sure new borrowers are better quality to offset the costs of the old ones.
Precisely. And that leads us straight into this strategic pivot. The data shows they're really working on deleveraging their existing customer base.
Deleveraging, meaning getting customers to borrow less overall.
Less from multiple sources specifically. They're focusing on borrowers with fewer simultaneous loans. Look at this number. The percentage of their GLP tied to borrowers with more than 3 lenders, it dropped significantly. 11.1% in June, down to just 6.9% in September.
Wow, that's a big shift in just one quarter.
It's huge. It shows real discipline on risk. They're actively reducing exposure to that kind of systematic over-indebtedness, which, is a major driver of defaults in microfinance.
Makes sense.
And you see it in another metric, too. Borrowers with high unsecured debt over INR 2 lakh. The share of the portfolio they represent also dropped from 9.5% down to 7.2%.
So actively managing down exposure to the riskiest, most leveraged clients.
Exactly. And this isn't just, ticking a compliance box. It feels like structural preparation for a time when regulatory provisioning is going to demand higher capital reserves anyway.
Okay, the risk control is clear. But what about the other side, the acquisition strategy? That looked really interesting, too. They added, 2.2 lakh new borrowers in Q2?
Yep. And here's the kicker. An impressive 39% of those were new to credit, NTC customers.
39%. Why is that NTC focus so important?
Well, it's a brilliant long-term play, really. When you bring in customers who are new to formal credit, you're often getting lower-risk individuals. They aren't already overloaded with debt from 5 other lenders.
Right, less baggage.
Exactly, and it ties into another point. Their share of unique borrowers, people borrowing only from CreditAccess Grameen, that rose too, from 36% in Q1 up to 41% in Q2.
So building loyalty and focusing on NTCs sounds like they're deliberately building a much cleaner, higher quality book for the future, focusing on single lender relationships.
That's exactly what it looks like, intentional quality improvement.
And is this quality push reflected in that product mix shift?
Yeah.
Towards retail finance or RF? That share jumped pretty fast, 6.8% to 11.1% just quarter on quarter. Why is RF seen as structurally better?
The RF segment. Yeah, that's a clear path for them to retain and, frankly, monetize their best, most established customers, their higher vintage clients.
How do they do that?
2 main ways. First, they're scaling up individual business loans, but running them through their existing group lending branches, so using the infrastructure they already have.
Okay.
Second, they're strategically reclassifying some of their top-performing group lending borrowers. If, after an income check, they find someone's earning over INR 3 lakh, they can potentially move them into this RF category.
I see. So it's like graduating their best customers.
Exactly. These individual business loans, they typically involve customers with a proven track record with the company. You're graduating your most successful clients into a product category that usually allows for better monitoring and, crucially, seems to already be showing relatively better asset quality than the standard group loans.
So it's risk mitigation dressed up as a sales strategy.
Pretty much, yeah. It's quite smart.
Okay, so portfolio cleaned up, check. Customer base pivoting to higher quality, check. Now we hit the potential wall. How do the financials, and especially the forward guidance, reflect this looming regulatory cost shock?
Right. The big elephant in the room.
Let's quickly touch on Q2 financials first. Profit after tax, PPT, was INR 126 crores. That's up a lot sequentially, like 109%, but still down quite a bit, 32.4% year over year. Which makes sense because of that huge provisioning hit we talked about.
Correct. The write-offs impact the bottom line directly in the period they're taken.
But operationally, the margins looked okay. NMM, net interest margin, 13.3%, interest spread, 11.1%. Seems healthy.
Yeah, the core operations seem solid. And their funding side looks good, too. Their weighted average cost of borrowing, the CO, it keeps ticking down. It was 9.6% in Q2. And the cost of new funds, the marginal COB, was even lower at 8.9%.
That's helpful. Lower funding costs give them some buffer.
Absolutely. It's probably their most powerful operational lever to help offset future expenses.
Okay, but now we get to the crucial bit, the revised guidance. They issued a significantly higher credit cost guidance for the full year, FY26.
That's right. This is the key takeaway for anyone looking ahead. They expect a deviation of 70 to 100 basis points above what they initially guided for.
70 to 100 BPS, that's quite a jump.
It is, and it signals this isn't just about one tough quarter. It's more like a regulatory mechanism ensuring that the pain, the data from the last few years of stress, gets structurally baked into their cost structure going forward.
Can you break down the 2 main reasons they gave? Something about delayed improvement in monthly PAR accretion and then this expected credit loss or ECL provisioning rate increase?
Sure. The first one's fairly straightforward. The rate at which new loans are starting to show delinquency, that PAR accretion, it's just still a bit higher than they hoped. They were aiming for maybe 25-30 basis points, but it's running more like 40-45 BPS.
Still sicky.
Yeah. But the second factor, the ECL provisioning, that's the big structural issue.
Okay, explain ECL simply for us.
Right. So ECL, expected credit loss. It's basically the calculation banks and NBFCs use to figure out how much money they need to set aside now for potential losses on their loans in the future.
Okay, based on predicted default.
Exactly. It relies heavily on their own historical data, specifically probability of default, the chance a customer won't pay back, and loss, given default, how much they actually lose if someone defaults.
Got it.
Now, the critical part here is that the model regulators often look at uses a 36-month rolling average of this PD and LGD data.
Oh, so even though they've written off the really bad loans from the recent stress?
Exactly. The data from that troubled period, the higher defaults and losses, still haunts the regulatory calculation for the next 3 years. It gets averaged in.
Okay, I see. So even with a clean current book, the higher PD and LGD numbers for the recent past are now being fully baked into the model, permanently pushing the required provisioning baseline higher.
That's precisely it. It forces a structural reset of their risk provisioning. And it's not temporary. Looking ahead to FY27, they're already anticipating credit costs between 4% and 4.5%. And that includes, they say, a one-time ECL rate increase of maybe 70, 80 basis points just from fully incorporating the recent stress data into that rolling 36-month model.
Wow. Okay, so management is forecasting a 4% to 4.5% return on assets, ROA, medium term by FY27. They say operational efficiencies will counter this higher cost. But given they're absorbing, potentially 70 to 100 BPs more in structural costs than they expected, isn't that 4.5% ROA target, well, extremely ambitious? Doesn't it rely on almost perfect execution?
It's definitely ambitious, no doubt about it, but perhaps not impossible if their levers work as planned.
What are the main levers then?
They're counting on improving their operating. How? Well, better yields, partly because with better asset quality, they'll have fewer interest reversals.
Okay.
Plus, they recently increased pricing by 75 basis points on group loans. That helps yields too. And the final piece is OPEX normalization, basically. As the loan book grows faster than their cost, the cost per rupee lent should come down.
So it's a high-stakes plan. Use aggressive cost control and price hikes to overcome a mandatory long-term regulatory cost increase.
That's the bet they're making, yes. Before we wrap up, maybe we should quickly touch on the non-financial stabilizers, things like governance and their specific operational model.
Good point. Stability matters during change.
Right. On the governance front, they seem to have secured continuity at the chairman level. They appointed Mr. Manoj Kumar. He founded Social Alpha, been on the board since 2019 as the new chairman and lead independent director. That took effect October 28th, 2025. Stability at the top is definitely helpful when you're navigating these kinds of structural shifts.
Makes sense. And operationally, this is a very boots-on-the-ground business, isn't it? 2,209 branches, 16 states, 1 UT. They talk about a high-touch, high-tech model. What does that actually mean in practice?
Yeah, the model is key. The high-touch part is the traditional microfinance element, the joint liability groups, the JLGs. That requires physical presence, relationship managers, knowing the community. Standard stuff, but crucial.
Okay.
The high-tech component is where they get their edge, especially in managing risk out in the field. They're constantly using tech for things like real-time risk monitoring. For example, their collection process is digitized. That data feeds straight back into their credit scoring models almost instantly.
Ah, so they can spot trouble brewing much faster.
Much faster, within a specific branch or even a small geographic cluster.
Especially given those localized risks we talked about, like the weather impact.
Yeah. Absolutely vital. And this structure, this tech-enabled field operation, is why their people are so important. Their employee base grew to over 21,700. And critically, they seem to have a good handle on attrition, keeping it around 28.9%.
Which is pretty good for the sector, right?
It is. In a business built on trust and relationships, keeping that experienced field staff is maybe their single biggest competitive advantage. It's essential for executing that high-touch strategy effectively and managing the inherent volatility of microfinance. Hashtag outro.
Okay, so let's try and summarize this deep dive. CreditAccess Grameen, GAGL, they successfully navigated the immediate storm, right? Massive balance sheet cleanup done, asset quality metrics stabilized, and they've strategically pivoted their customer acquisition towards higher vintage and, importantly, new-to-credit borrowers.
Yep, tactical success on those fronts.
But that success came just before they had to confront the need to absorb this significant, structurally higher credit cost, mainly driven by that 36-month rolling regulatory ECL model incorporating past stress.
Right. The past catching up via regulation. Management is fundamentally betting that their deep rural reach, the efficiencies from that high-tech, high-touch model, plus those recent price hikes, that all this will be enough to keep hitting those 4% to 4.5% ROA targets, even with a higher long-term provisioning cost baked in.
Which leads to a really interesting question for you, our listener, to think about.
Given how sensitive these rolling regulatory models like ECL are to recent periods of stress, we saw the impact here for FY26, FY27. How might NBFCs like this one need to adjust their long-term growth and pricing strategies, not just the short-term fixes, but structurally? How do you mitigate that constant risk of the rolling calculation creating future volatility down the line?
A fascinating challenge. Regulatory compliance meeting operational ambition head on. Well, that's all the time we have for this deep dive. Thanks for joining us.